Let's continue with our next topic, the audit approach. You see, auditors have different means or different ways of auditing. So there are different ways and means by which you can approach the audit. Therefore, let's discuss the audit approach. In another word, it's called audit strategies. Strategies are the means and ways by which you can achieve your objective. Therefore, it is audit strategies. That is the approach you, the auditor, is going to take to come out with your audit reports. A choice of audit strategies. There are so many choices or ways by which you can approach the audit. But mostly it is grouped into four main approaches to audit. An audit strategy is the overall approach that the auditor decides to take for an audit. So audit strategy is the overall approach that the auditor decides to take for an audit, from which a detailed audit plan can be developed. So the audit strategy is bigger than the audit. So there are four main ways by which auditors can approach their audits. The first one is what we call business risk approach. That is common in most of the organizations or the audit firms. Or another way is what? Risk-based approach. Many audit firms audits based on the risk they have identified. So we call it a business risk approach or risk-based approach. That is the modern way of auditing. The second system is what we call a system-based approach. The third one is what? Synthetic testing approach. We are going to elaborate more on all these things. Then a statement of financial position approach, usually for small entities. Usually for what? Small entities. These audit approaches or strategies place, you may be asked in a question or a question may be asked. So look at the conditions under which we are going to discuss them, and then you know the strategy you have to adopt. But they are saying that financial position approach can only be done or that strategy be picked if you are auditing a small entities. So in the scenarios the scenario may be given to you. If they give a scenario and the company is a small company, then you can use what? The statement of financial position approach. Okay? But as far as the three are concerned, statistic testing, system-based approach, business risk approach, all of them, it will depend on some circumstances. When we go into detail, you get to know. These strategies are not mutually exclusive. What do you mean by mutually exclusive is that they don't rest if they say statistic testing. It doesn't mean that you use statistic testing all throughout without basing it on risk or system-based. No. They intertwine. When you are using risk-based, you still use statistic testing. You sometimes use system-based. So meaning that the three approaches move hand in hand. They move along. Okay. These strategies are not mutually exclusive. And they may be used in what? Combination. So summary of available audit strategies are here. So what do you mean by statement of financial position approach? I told you that this one can only be used when it is what? A small organization. This approach concentrates on the statement of financial position figures using subtractive testing. Have you seen it now? On the argument that if the opening and closing statement of financial position are accurate, then the profit or loss for the year must also be stated accurately. That is it. And this one is for only small organizations. Then the next one is risk-based approach and business risk approach. You can either call it business risk approach or risk-based approach. How does this approach work? First, as an auditor, an assessment is made of the likelihood of what? Material misstatement. existing in each area of the audit. Each area of the audit. So every auditable area, you assess the risk. Procurement system, the risk there. Payment system, the risk there. Payroll system, the risk there. You assess all these risks. Then areas that are assessed as high risk are audited extensively. So when you assess the risk, we have high risk areas, medium risk, and low risk. So high risk areas are audited extensively using synthetic tests or system-based approach and analytical procedure. What I just say is that all these tests, these procedures can be used in risk-based. But high-risk areas, you use more time and experienced people to do that job. That's why they say extensively. The areas assessed as low risk are given a low level of attention in the audit. Areas that you consider to be very low, you don't waste too much time there. And there you can also, low risk areas, even inexperienced, audit officers can be assigned these jobs. The auditing methods apply mainly by large audit practices. So this particular risk base is used especially by big large audit practices. Focus on business risk rather than overall audit risk. Business risk. Now, synthetic testing approach. This approach focuses on applying synthetic tests to a large number of transactions. When they say synthetic testing, it means detailed testing. Detailed testing. So these are then this focus on recorded transactions and balances. Recorded on Recorded transactions and balances. Synthetic testing. Then this approach is time consuming and costly for the audit of large companies. Time consuming. This approach is appropriate where systems and controls are weak. Once the systems and controls are not working effectively, then you need to use synthetic testing, detailed testing. That's what you mean. It is widely used for the audit of smaller entities where controls are likely to be weak. Synthetic testing, yes. Then there is a danger of spending too much time auditing transactions. Yes, there's a danger there. You have to waste too much time on all the figures. There is a risk that misstatements in the financial transaction will not be detected unless all transactions and balances are tested. Yes, because you are using synthetic testing means that you will be testing all figures. So when you didn't test, it means it will not augur well for you. The system-based approach. What is a system-based? The audit focuses on the application of tests. Focuses on application of tests of control to the system that produce the figures in the financial statement rather than on the figures themselves. What they are saying is that system-based approach is used when you want to focus on application of tests of control to the system. System-based is where management puts system in place. And those systems are procedures and policies need to be followed. And therefore, all your concentration is on the system that has been put in place. If the system is working well, then it means that the transactions or the figures that are coming through the system may be okay. So there's going to be reliance on internal controls. So you have to test the controls. So a system-based approach is supported by some degree of synthetic testing. So what they are just saying is that you don't do system-based in isolation. You also support it synthetic testing, detailed testing, because of unavoidable limitations and weaknesses in internal control. Because of weaknesses in internal control, this system-based approach relies heavily on internal controls. So if the system is not working well, then automatically it is bad for you. So it is also supported by the use of analytical procedure. So in a system base, we use analytical procedure as well. It is more cost effective than a full substantive testing approach. So it is, and in terms of cost, it is lower than that of what? Substantive testing. Factors in the choice of audit strategy. This is an auditable, question area. They can ask you question, and then you have to use any of these elements in selecting the strategy you are going to adopt. The selection of the audit strategy will depend on a number of factors, including the nature and size of the client's business, the nature of the business, and the size of the business. So that is one factors in the choice. If it's a small company, we use what? We use, what do you call it? You can use the system base, you can use statistics tests, and you can use what? Financial position method. The control procedures and control environment in place. In this case, if the controls are working or there is no control in place, then the method will depend on whether there are controls in place or there are no controls in place or control environment in place. Then we have also what? The audit methods and techniques favored by the audit firm. Some audit firms rely deeply, especially the large big organizations, firms. They use the system-based auditing approach. Okay, so if that is what, so there are three factors there. We have the nature and size of the client business will determine the choice of the strategy. Then the control procedures and control environment in place will also determine the choice of what? Audit strategy. Then we have what? Where we have methods and techniques favored by the audit firm. Which method you favor or your audit firm favors. You may be asked to select and justify an audit strategy for a particular client in the examination. That's what I was trying to say initially, that you can be asked to select a particular strategy for a client. And the three at the top will guide you as to which strategy you are going to adopt. In which case, you will be considering factors such as what? These. The one above, okay? Business risk approach. What is a business risk approach? So we are going to take all the strategies one after the other. So business risk approach. So they said the development of audit strategy and practices. So one, audit practice has developed significantly over recent years. The main reasons have been the increasing size and complexity of business units and the challenges created for the audit by size and complexity. Two, an attempt to improve the efficiency of the audit process. The first major development in the normal audit approach was a switch from an emphasis on substantive testing to a system-based approach. Then the concept of risk-based audit developed. So currently, the most current method is what? Risk-based. More recently, larger audit processes in particular have what? Developed business risk approach to audit work. The meaning of the business risk approach now. The business risk approach involves what? The auditor looking at the business as a whole and carrying out an evaluation of the risk to which it may be exposed. Transport business are exposed to peculiar risks. And then let's assume we have another manufacturing companies also are exposed to what? Different kinds of risks. So you look at the risk that particular institution faces. The auditor identifies the business risk which may have an impact on the financial statement of the client company. So it is your duty to identify various risks that your clients, the general approach is to what? Identify the key business risks facing your clients. Evaluate the possible impact on the financial statements. After you have identified the risks, then you must evaluate its impact on the financial statement, and then you plan the audit you plan the approach to the audit around the key business risks that have been what? Identified. This approach cannot work effectively unless the auditor has a good understanding of the client business and the environment in which it operates. Nature of the business risk approach. Nature. The business risk approach is sometimes referred to as the top-down. As what? Top-down approach to an audit. The approach starts at the top with the business, which generates the financial statements. The business generates what? Financial statements. The approach ends at the bottom with the financial statement, which record the outcome of the business transactions. So that's the business risk approach for you. The business drives the the business drives the financial statements. This is a high-level approach to audit and has similarities with business management and strategy. The auditor is interested in business risk not for its own sake. They say you are interested in business risk not for its own sake, but in the light of its possible impact on the financial statements. So you are talking about risk that will impact on the financial statements. Internal business risks and external business risks. There are two types of risks as far as companies are concerned. We have internal business risks and external business risks. So external business risks, examples of external business are the possible loss of a major contract as a result of dispute with the customer. That's one. A possible loss of a major contract as a result of dispute with the customer. Two, the long-term decline in demand for the company's products and failure to invest in research and development. So this is a long-term also decline. Then the impact of new competitor moving into the market. Yes, these are all external. Then the impact of proposed changes in laws and regulations. They are coming from outside. The effect of recently discovered new technology. Yes, that is where most people nowadays don't use typewriters because they are archaic. The effect of changes in the macroeconomy. Then the impact of natural hazards. Threats from competitors to a company's what? Patents or copyrights. All these are external risks. Then internal business risks within the business itself. Examples include what? Internal business risk might include the following. Risk arising from where? Risk arising from ineffective employees or weak management. It is within. You employ the staff, but they are not working effectively. Therefore, it's not from outside. The risk from a lack of customer care and attention to customer needs. Yes, it is the staff who need to take care of the customers before they can come back again. So failure to do that is not from outside. Poor financial management, such as excessive levels of gearing, poor cash management, and poor working capital control. It's management problem. Poor financial management. It's within. Lack of finance for capital expenditure on equipment, replacement, or modernization. These are within. Risk due to what? System weaknesses or system failures, internal control weaknesses. Is it from outside? No. Risk from over-reliance on one or two key individuals. Yes, you are relying on one particular individual or two people. Then if there's a failure, then it means you made it. The risk of fraud or the misappropriation of assets. All these things are internally generated what? Risks. Now, after you have identified the risks, you need to evaluate the risks. Not all risks are of equal significance. Yeah, it's true. Some risks are so heavy that once it comes, the whole company is dancing. So they are saying the significance of a risk to the auditors depends on two factors. So how significant a risk is will depend on what? Two factors. One, the impact of that risk. the impact that it will have on the financial statement if an adverse event occurs. It is the size of the risk. So that's one, the impact it will have on the organization and the financial statement. The second one, the likelihood or probability that an adverse event will occur, so that the risk becomes reality. So we are talking about probability, whether it will actually come or happen. So we are looking at these two factors, the impact and probability. Risk assessment model. So you can assess risk, you can put risk into two models. You have high impact, then likelihood, and then low likelihood. So high impact means that if it happens, then high likelihood. So category 1, that means high risk. You can make it category 2, which is risk, category 2 risk, low likelihood, then low impact, and the rest. These are just advantages of business risk approach. What are the advantages? Every approach has its own advantage and disadvantage. So what are the advantages of business risk approach? The approach requires the auditor to acquire an in-depth knowledge of the client's business. That is the approach. Advantage that you, the auditor, will have in-depth knowledge in the client's business. The second one is the business environment is changing rapidly. A business risk approach keeps the auditor up to date. We are now moving on with so many introduction of different things. And therefore, once the environment is changing, the risks also change. It keeps the auditor up to what? Dates. Current risk compared to previous 10 years risk. The evidence suggests that major audit problems are more likely to result from what? Business-related problems than from internal control weaknesses. Evidence suggests that major audit problems are more likely to result from business-related problems than from internal control weaknesses. Then a business risk approach may allow the auditor to add value by making effective recommendations to improve the performance of the client business. That's one of the advantages. Audit costs may be reduced because there is less audit testing, which saves time, especially the time of junior audit staff. Then the approach may benefit the auditor's own business because its use of a modern business risk approach may differentiate the firm's audit services from those of its competitors. There is nothing that has advantages without disadvantage. So, disadvantages of the business risk approach. What are the possible disadvantages? 1, the business risk approach requires audit staff with suitable experience, including partners and managers. Experienced staff, audit staff. Then the second one is business risk approach requires a closer involvement by the auditor in the client's business. Closer involvement, meaning that you have to understand the business and the system that you are auditing. Some auditors feel uneasy about the broad view taken by the business risk approach. It's a disadvantage. Some people say, and consider a system-based view to be more appropriate for reaching an opinion on the financial statements. Then the approach may be effective only for the audit of larger companies. Those are some of the disadvantages. Comparison of business risk and financial statement risk. Business risk and financial statement risk. Business risk is a risk that the business entity will fail to meet its objective. Yes, that's the business risk. Business risk is a risk that the business entity will fail to what? To meet its objective. Financial statement risk is the risk that the financial statement will not give a true and fair view due to misstatement and what? Omissions. So they can ask you in examination to differentiate between business risk and financial statement risk. Be able to explain it to the examiner. There is normally a close connection between these two categories of risk. So they are closely connected. One, when there is a significant risk, a significant business risk, failure by management to deal with the risk could affect its items in the financial statement. That's it. It's true. Then weaknesses in internal control are business risk, which could result in misstatement in the financial statements. Now let's come to the systems-based approach, which is one of the approaches, audit strategies. System-based approach. The nature of a system-based approach to an audit, the nature. So a system-based approach to an audit focuses on the internal control system of the client company and the adequacy of its internal controls. Systems are procedures and policies put in place by management to enable them to achieve their objective. So those systems they have recorded, they put in place, and we call them internal control systems. So that is what they are saying, that it's a system-based approach to an audit focuses on the internal control system of the client and the adequacy of its internal controls. Yes. The auditor is required by ISA 315 to obtain an understanding of the entity and its environment, including its internal controls, its environment, and what? Including what? Its internal controls. It is the responsibility of management to put in place a suitable system of internal control to address identified financial statement risk, operational risk, and compliance risks. Okay, I said it already. Effective internal controls, provided that they are what? Implemented properly, should ensure what? Reliable financial reporting. Yes. Once there is an effective internal controls in system, and it is properly implemented, then it will ensure that reliable financial reporting will be prepared. And then the effectiveness and efficiency of operations will go on, and then comply with appropriate laws and regulations. The effectiveness of internal controls. Now, testing the controls for effectiveness with a system-based approach. The auditor aims to what? Rely on the accounting system and the related internal controls to ensure that transactions are properly what? Recorded. His assumption is that if the system and the internal controls are adequate, the transactions should be processed correctly, and the financial statement should therefore give what? A true and fair view. That's the assumption. System-based. If the system is properly operating and transactions are properly recorded, the presumption is that the financial statements that will come from the system will be a fair one. The audit emphasis is therefore as much as possible on the systems that process the transactions rather than on the transactions themselves. What they are saying is that if you are using a system base, your emphasis is on the system. The system that processes the transactions rather than the transactions themselves. Before the auditor can rely on the system and controls that are in place, he must establish what those systems and controls are and carry out an evaluation of the effectiveness of the system. Yes, before you can rely on it, you need to know the system that are in place, how they work. That is, you are evaluating how effective it is. What makes an effective system for internal controls? What makes an effective or alternatively component of internal control? Component of internal control. So they are saying ISA 315 identify 5 components which together make up what? An internal control system. For any internal control system, it should have 5 components or 5 elements. The first one is the control environment, followed by the entities risk assessments process. Entities what? Risk assessment process. followed by information system, control activities, and then the review and monitoring of controls. Now we are going to take them one after the other. So we come to what? The control activities. What constitutes control activities? Oh, sorry, control environment. What constitutes control environment? Sorry for that. The control environment is often referred to as the general attitude. The general what? Attitude to internal control of management and employees in the organization. The control environment includes the following elements. So when they say control environment, it is the environment in which the control works. That's why they say general attitude to internal control of management and employees in the organization. So the first one is integrity and ethical values. Integrity of the staff and the ethical, how they perceive ethical values. Then management philosophy and operating style. How management operates and then their operating style. Then organizational structure. Organizational structure, how the organization is structured. The assignment of authority and responsibility. Then human resource policies and practice. Competence of personnel. All this 7 elements constitute what we call control environments. First one, integrity and ethical values. How they perceive it. Management philosophy and operating style. Organizational structure. Assignment of authority and responsibility. Human resource policies and practice. Competence of personnel. So when we have a strong control environment, a strong control environment is typically one where management shows a high level of what? Commitment to the establishing and what? Operating sound controls. Yes. Means that management regard internal controls very high, and they commit themselves to the what? Those controls. Evaluating the control environment. Yes, how do you evaluate it? Whether the environment is conducive or is not conducive. ISA 315 requires auditors to what? Gain understanding of the control environment. You must understand the control environment in which you are going to audit. Part of this understanding involves the auditor evaluating the control environment and assessing its effectiveness. In evaluating the control environment, the auditor should consider such factors as what? Management participation in the control process. How management participates in what? Control process, including participation by the board of directors. See how they take part in the what? Process of what? The controls. Then management commitment to control culture. Management commitment to what? Control culture. How they are committed to it. The existence of an appropriate organization structure with clear divisions of authority and responsibility. An organization culture that expects ethically acceptable behavior from its managers and employees. Yes, there should be organization culture that expects what? Ethically acceptable behavior from its managers and what? Employees. Appropriate human resource policies covering recruitment, training, development, and motivation, which reflect a commitment to quality and competence in the organization. All these are how the ways and means by which we evaluate the control environments. Entities risk assessment process. How do we assess risk? Entities risk assessment process. How do you assess the risk? They are saying that ISA 315 requires the auditor to gain understanding of this risk assessment process used by the client company's management, to the extent that those risk assessment processes may affect the financial reporting process. The quality of the risk assessment and management process within the client company may be used by the auditor to assess the overall level of audit risk. If management has no such process in place, the auditor will need to do more work on these aspects of the audits. Information system. Information system. What do you understand by information system? This aspect of the auditor's work will involve what? Identify and understanding the following. So, what is information system? Now, they say the entity's principal business transaction. You must know the entity's what? Business what? Transactions. How these transactions and other events relevant to the financial reporting process are captured by the entity or identified and recorded by the entity. Then the processing methods, both manual and electronic, apply to those transactions. How do they process the informations? The accounting records used, both manual or electronic, to support the figures appearing in the financial statement. And then the process used in the preparation of the financial statement. These are how the information system works. They continue. The information system, therefore, consists of what? The infrastructure, both physical and what? Hardware components. That is, manual accounting systems may have little infrastructure. Yes, but now because we are using IT and processing all our transactions, there should be proper infrastructure in place. There should be a software that's in IT-based accounting system. We have software to process the transactions. The people, those who are involved, then the procedures and the data that you'll be capturing. Control activities are, now let's go to control activities. What are control activities? Control activities are the practices and procedures other than the control environment used to ensure that the entity's objectives are achieved. They are the application of internal controls. So control activities are the application of internal controls. Control activities are the specific procedures designed to prevent errors that may arise in processing information. Yes. Controls are policies and procedures put in place by management to enable them achieve their objective. Is that also? Therefore, to detect and correct errors that may arise in processing information. So control activities include what? How to prevent errors in processing information, and how to detect and correct errors that may arise in processing information. Categories of control activities. We have different categories of control activities. Different categories of control activities. We have internal controls. Internal controls include the following types. Authorization controls, accounting controls, management controls, physical controls over assets, arithmetic controls, segregation of duties. So these are the types of control activities. 1, authorization controls. This requires that all significant transactions must be authorized by a manager at an appropriate level in the organization. So authorization means that somebody must authorize any transaction before it is executed. The accounting controls are controls that are provided within accounting procedures to ensure the accuracy or completeness of records. So if you go to accounts office, how they capture the information, who captures which information, and how the informations are stored for future use. These are the accounting controls. The management controls are those controls that apply by management, Then physical controls over assets. These are controls for safeguarding assets from unauthorized use or from theft or damage. Controls like, let's say, how the stores are prevented from, are kept, how the store items are prevented from intruders having access to those store items and so forth by providing securities at the gates and the rest. Then we have arithmetic controls. These are checks on the arithmetical accuracy of processing. And then segregation of duties. This type of control is explained in the next slide. That's what they are saying. Then we said that segregation of duties means that dividing the work to be done between what? 2 or more individuals, so that the work done by one individual acts as a check on the work of the other. So the work is divided in such a way that one serves as a check on the other. So the work is divided in such a way that one particular part of the work serves as a check on the other. This reduces the risk of error or fraud. If several individuals are involved in the completion of an overall task, this increases the likelihood that errors will be detected when they are made. Yes, it's true. It is more difficult for a person to commit fraud because a colleague may identify suspicious transactions by a colleague who is trying to commit a fraud. Yes. Monitoring of controls. How do you monitor the controls? Yes. That's where the internal audit also comes in. It is important within an internal control system that management should review and monitor the operation of their controls on a systematic basis to certify themselves that the controls remain adequate and that they are being applied properly. ISA 315 requires the auditor to obtain an understanding of this monitoring process. And that is one of the work that is done by internal auditors. They monitor the system, the internal controls that the management put in place on their behalf. How the auditor uses internal controls. The auditor relies on the accounting system and the related controls to ensure that transactions are properly recorded. Understanding the controls. Now, ISA 315 requires the auditor to gain an understanding of each of the 5 components of client's internal control system. So you are supposed to know all the 5 components. Then document the relevant features of the control system. The first thing that the auditor needs to do is to gain an understanding of what? Each of the 5 components of the client's internal control system. Then secondly, you must document the relevant features of the control system. Documentation. Once this understanding has been gained, the auditor should confirm that his understanding is correct by performing walkthrough tests. Walkthrough procedures, which is the same as walkthrough tests, on each major type of transaction. So once you have now gained understanding of what the policies and the controls in place, you now test your understanding by performing a walkthrough tests. Assessing the effectiveness of internal control. The degree of effectiveness of an internal control system will depend on the following 2 factors. So every internal control system will depend on the design of the internal control system, and then the proper implementation of the control. So in a nutshell, for any controls, the auditor needs to know how it is designed. So the design of the control and the proper implementation of the controls. Controls are not effective unless they are implemented properly. The auditor's evaluation of internal controls. How do you evaluate the internal controls? The auditor may judge that the control risk is high or that the control risk is low because the internal controls are effective. So it depends. If the auditor assesses that the control risk is very high, he will probably take the view that a system-based audit approach will not be appropriate. So in selecting your strategy, where there's a high risk in the internal controls, system-based will not work. He will therefore move on to detailed testing of transactions. That's where you use what we call syntactic testing. Before he can assess the control risk as low, the auditor must certify that the controls are well designed, first one, and should be effective. The design and the effectiveness of the control. Okay? Even if the controls appear to be acceptable on paper, the auditor cannot rely on them and perform a system-based audit unless he is confident that the controls are actually working in practice. You go to some organizations, they have what you call manual, internal control manuals. You read through, but don't use system-based audit unless you test the controls and see that the controls are working effectively. In this situation, the next process is carried out to test control. Okay. Now, this is a summary of all what we have said about internal controls. Summary of the approach to reliance on internal controls. So before you rely on internal controls, there's a diagram will demonstrate. So before you plan, there's a planning and risk assessments. So when assessment of internal controls are weak, then you go to what you call extensive substantive testing. But if you assess internal controls and they are very strong, then you come to what? Test of control. You have to test the controls. Once you test the controls and they are working what? Effectively, then you reduce your substantive testing. But if you test the controls and the controls are not working, you go to substantive testing. And that is all the two of them match at overall review of the financial statements. The statement of financial position approach. Substantive tests are audit procedures performed to detect material misstatement in the figures reported in the financial statement. They are designed to obtain evidence about the financial statement assertions. They include what? Tests of detail on transactions, account balances and disclosures, and analytical procedures. Statement of financial position approach. Continue. The statement of financial position approach is also an approach to the audit based wholly on substantive testing. Based wholly on what? Substantive testing. So substantive testing and statement of financial position approach are the same. However, with this approach, the auditor concentrates primarily on what? Testing balances. Testing what? Balances. That is where they say financial position approach, as opposed to what? Testing balances and transactions. So in this case, you are testing balances instead of what? Testing balances and transactions. If it is an approach that is often well suited to small companies and to companies where assets and liabilities are substantial in relation to transactions. This approach is based on the following accounting equation. We are saying that opening net asset plus profit for the year, and that will give you closing net assets. So statement of financial position method or strategy is based on this equation, that opening net asset plus profit for the year equals to closing net assets. So if you are able to get the closing net assets and you get the opening net asset and you want the profit for the year, you just subtract the opening net asset from the closing net asset. The difference gives you the profits for the year. The theory is that if the opening and closing statements of financial position are correct, then the profit for the year must also be correct. That's it. Smaller entities. ICES apply to the audit of all entities, irrespective of their size. However, additional considerations specific to audit of what? Smaller entities are included within the application and other explanatory material of what? ICES, where appropriate. Thank you very much.